Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Yesterday afternoon, the Reserve Bank Board left the official cash rate on hold at 3.85%. A surprise decision, given most economists and financial markets expected a reduction of 25 basis points. In the press conference after the announcement, Governor Michelle Bullock was at pains to explain that the decision didn't mean that the central bank is thinking differently about rates. Rather, it's a timing issue. To run through yesterday's announcement, I'm joined by Westpac Chief Economist Lucy Ellis, who of course used to be the Chief Economist at the Reserve Bank. Lucy, welcome back to Fear and Greed.
Thanks very much, Sean. Great to be here.
What do you make of yesterday's decision and the press conference afterwards?
Well, Sean, the Reserve Bank Board said in its May minutes that it wanted to approach policy in a cautious and predictable way. And it has to be said that this week's decision really does err on the side of caution rather than predictability. While they do say that they've got in the next 4 weeks, a full quarterly CPI and the labour force numbers, it's honestly speaking not a lot of new information, and nothing that they get in the next little while is really going to change the decision that rates are headed down. So the real question was, what are you waiting for? And it does seem that the RBA has gotten itself into a bit of a view that, they can't look at the monthly CPI indicator as an indicator of the quarterly. I mean, we have 2/3 of the information now. And while it is pointing to something a shade above what they were forecasting in May, it's not a big difference. It's like there's nothing they're going to learn in the next 5 weeks that will change their mind. And so it's almost not a surprise that the decision was split 6-3 because I think that was, a very finely balanced judgment. And, the argument to wait was, well, we're waiting because we can and we're being cautious rather than, policy is restrictive, inflation's at target, we don't need to be as restrictive as we were. And I think what was really interesting in the media conference was they didn't really talk about the stance of policy that much. They didn't highlight that policy was restrictive. But what they did emphasise is, relatively dated information about inflation that was only barely within the band. So they emphasised, trim mean inflation, year-ended March quarter. Well, firstly, we're in July. We have 2/3 of the information about June quarter.
Yeah.
And a year-ended calculation, half of the information is from the middle of last year. So they're using quite dated information to make that assessment.
Do you think there's something going on non-economically in as much as we have a new monetary policy setting board? It operates differently to what it did kind of 4 or 5 meetings ago. The fact that people are voting, we found out that it was a 6-3 split decision yesterday. All this information, does it just make it harder for the Reserve Bank to kind of know what's going to come out of the meeting before it goes into the meeting compared to, let's say, 12 months ago or when you were there, for example?
Look, I think people need to understand that the board were not patsies. They were not a rubber stamp. And it was a misreading of the dynamics of the board and the conduct of the board to assert that they were just a rubber stamp. These are very distinguished people who are accustomed to making decisions under uncertainty. The assumption that they're just a rubber stamp was false. Why would the staff put up a recommendation that they didn't think they could get up? So I think this one was quite finely balanced. And I do wonder quite what was going on. I don't think it was the case that, the internal people, the governor, the deputy governor and the new secretary of treasury were the ones who voted for a cut.
Yep.
I think it was 3 external members who voted for a cut. It's a bit hard to know that. They'll never reveal that, but that's just my sort of read of, how things have played out. But the idea of, we can wait another 5 weeks. Well, you didn't need to. It's not clear what the confirmation they needed. Why are they still not convinced that inflation's inside the band and sustainably there? So, let's then look at the things that they cite as indicators of why they want confirmation. They're talking about the the recovery in private sector demand growth. Well, we do all expect that, but they have been disappointed by that over recent quarters and have had to revise their consumption growth forecast, their near-term consumption growth forecast down. They're obviously concerned about inflation picking back up again, and particularly about unit labour costs and low productivity. And I thought it was interesting in the media conference after the meeting that the governor talked about a conundrum that inflation was coming down, but unit labour costs were high. And our view at Westpac Economics is really that what we're seeing there is a central bank that still puts a lot of weight on this sort of unit labour cost idea on a whole of economy productivity growth concept that isn't actually that important for determining inflation. And this is something we've been talking about for about a year at Westpac Economics, but it is just something that they don't come to their views about the economy lightly. They do put a lot of effort and care and modelling into their view, and so they don't change their mind lightly either.
Okay, stay with me, Lucy. We'll be back in a minute. I'm talking to Lucy Ellis, Chief Economist at Westpac. Just before the break, you were talking about unit labour costs and just Westpac Economics' view on that, the Reserve Bank's view on that. I just want to delve into that a little bit more because I wasn't quite with you on what you were saying. Is the Reserve Bank, is it an outdated idea, the idea of productivity and unit labour costs?
I don't think it's an outdated idea, but I just think it's one that needs to be handled with care and not taken literally. So there's still this concern that inflation might not be sustained at the midpoint of their target range. They're still concerned about upside risks to inflation for two reasons. One is the labour market is tighter than what their models are telling them full employment is.
Mm-hmm.
And secondly, measured productivity growth is quite weak. And they're reading that as a reason to be concerned that unit labour costs could start pushing up, putting upward pressure on overall costs. And although at the moment businesses are struggling to pass this on, and the Reserve Bank acknowledges this, they just think that's sort of an upside pressure on domestic inflation. And I think our response to that would be, firstly, the productivity growth. And you've got to remember, this is just GDP divided by hours worked. It's just stuff divided by time. And the problem is that the stuff divided by time includes sectors like the mining sector, which don't have much impact on domestic inflation, but also the non-market sector, your health and education and childcare and disability care, where the price isn't set in a market. And so the idea that prices are a markup over costs, including labour costs, is just not relevant. And if you restrict yourself to the parts of the economy where it's a reasonable assumption or a reasonable thesis that prices are indeed some kind of markup over costs and the prices are set in a market and this is relevant for domestic inflation, that bit of productivity is actually doing okay. And this is something we've been saying for quite some time, but it's just taking the RBA a while to sort of shift away from the kind of the thesis that they had. And then I was saying, well, if productivity growth doesn't pick up, then wages growth will have to slow. It's like, well, if productivity growth doesn't pick up, well, then firms won't accept wage increases as big as they currently are. So this is sort of self-correcting. We're just a lot less worried about this. And this is something we've been writing about for a while.
It's nice to hear some good news on productivity. Back to rates. Rates will fall, though, at some point in the next few months, Lucy.
Yeah, well, I mean, if you're listening to the press conference, I mean, it really felt like unless they get an upside surprise in the June quarter CPI, they're going to cut in August. I mean, as you're saying, in the next 5 weeks, we're going to see this and we're going to have another opportunity to review. I think there's a different, we did say where, at the time that we didn't think that a rate cut in July was a shoe-in and that they were wanting to be cautious. And, in retrospect, I should have said it's not a shoe-in, maybe not change my call. I think, we were right to say, there's a risk that they don't go and that the market was overpricing it. I am still surprised that in the end they decided to hold. And the fact that it was 6-3 split, I think, shows you just how finely balanced that was.
So what's your call now in terms of rate cuts for the rest of the year?
Well, we are still expecting further rate cuts. Probably August. There's now some chance that they delay further. They're obviously just, remaining to be convinced. But I think more likely than not, what we thought would be August, then we thought July is now going to be August, and this is just tactics and timing. And then the other point being, we had said, look, we don't think that they're going to back that up, back to back to back. And sure enough, so that just sort of cements the idea that if they do cut in August, they're not going to back that up with one in September. They're going to wait till November. So it's sort of like basically their statement on monetary policy meetings. So the quarterly meetings are the ones that are live, and they're going to wait till they've got that full suite of information before deciding. And so assuming we're right about it now being August for the next cut, then, November, February, May, the S&P ones, cautious and predictable with an emphasis on cautious. And I think that also emphasises that, it's now more likely that, what we'd called as being the trough, which was 285, is now more likely because, the more cautious they are, the more likely it is that they get to the end of the year and say, oh, crikey, actually inflation's undershot what we thought and we need to do more. And that is the basis for the 2 cuts that we're expecting next year, is we just think the RBA is going to get a bit caught out. Our own forecasts do see trimmed mean inflation coming into the lower end of the 2 to 3% target range. And so, we just expect that they get to the end of the year, realise that their previous forecast of 2.6 as far as the eye can see wasn't what was going to play out. And so they end up saying, oh, we have to do a bit more. And that's why we think there are 2 more cuts next year as well. So 2 this year, 2 next year.
Lucy, thanks for talking to Fear and Greed.
Thanks very much, Sean. Always a pleasure.
That was Lucy Ellis, Group Chief Economist at Westpac. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, business news you can use. I'm Sean Aylmer. Enjoy your day.